All right, happy Sunday morning to all you devils out there. Sam here with you on, it's about 10 o'clock, February 7th. And I thought this might be a good opportunity to offer a little bit of a historical context on this algorithm. Here, as you see Bitcoin here on a 60-minute completing a perfect golden corner pocket. So the remainder of this video here is going to be an excerpt from a webinar I did for Ninja Trader. So back in the summer. Now, some of you may have seen it. But we have a lot of new members and a lot of new subscribers on the YouTube channel here, so I thought perhaps there would be those of you that had not seen it or were not familiar with how this algorithm became so central to our methodology. So I thought I just pulled out an excerpt of that webinar here to give you a little bit of the history of how it was derived and how we came to include it so predominantly in our methodology here. A couple things to note here. So you will see here that if we stay in algorithmic scale here, for the pull from this, there is a slight break here, right? It's a slight break here. Now, if we go to log scale, which we've been looking at the longer term, you get a clear cluster here of golden zones here, but we're a little short. Now, if we go to algorithmic here, we get a slight overlap. Now, the idea here is that if we do get a slight break here, and you can't know what happened here. Right, so it's very possible there's an algorithm here that has modified this slightly. Again, this is now, well documented in the public domain. I'm not the only person who teaches this, right? I did not discover this, right? But we recognize there was something happening here. So the history lesson that follows this will give you some context as to, again, to where it came from and how it was discovered and how we came to make it such a cornerstone of our methodology. But the idea here is regardless here, so clearly they stayed with it, right? So it could be they've expanded the range here. We're never going to know. But the theory from our perspective here in context of how this was derived, if you do get a break here, you want to pull back to the next pivot, right? And then you get it's just perfect, right? It's tick to tick, right? And then now add the median lines here and we get Andrew's trading principle number one is that if we get a good pivot here, right, regardless of the fact that it's a golden zone here, as long as you get a pivot here, as long as this holds, you have 80% probability of making the median line. And you see, it's just not only is it, go right to it and tag it, and then you see the reaction, but it does it in a clear impulse, right? So again, this is a combination. This is in large part the TDU methodology all in one chart here. So we have a golden corner, we've got a golden corner pocket via the median lines, and then we have a clear Elliott impulse here, and now we see the market reacting to that. Now what's interesting about this is that on the way down, it's just as precise, right? As you'll often hear me say, this is the dominant algorithm in every liquid market, right? There are no exceptions. There is no market in any time frame where you will not find this to be the dominant algorithm. Now, there are certainly plenty of times where it breaks, right? That's not what I'm saying, that it never breaks, right? Obviously, it has to break, right? Or we just go sideways forever. But often you will see the market stuck between two golden zones. It's remarkable how often that happens. But if we go back, just looking at the legs coming down here, and then I'll just wrap up here shortly. So let's go. I gotta remember where I put them. Okay, so let's take these. Let's take these off. Oh, shit. Where do I have this? Oh, here it is. Okay, let's take this off, and let's just do it this way. All right, let me get back over here so I can show you this one coming down. Okay, so this is what I was trying to get to. I'm not good at organizing these. I'm going to work on that. All right, so swing, golden zone here. Now, you see there's a little pause here at the first target, but this keeps going, right? It's got more legs. We get wicks down here. So we get second target as well, right? These are the two most common targets, the negative 23.6 being the most common, negative 618. And then if we were to get a true 1618, it would be right in line, right? Members, you all know that's just a shortcut to getting to it since we go golden zone. So you'll note here, it's the precision on both sides. Now, additionally, there's another pitchfork in here. I believe it's this one, right? So you can see here, look at the precision here. So we're coming from this. Again, this is a great example here because I can label this up here. I probably should have done it. I can label this up here, right? So 3, 4, 5, right? So you see it going up and coming down, all coming from a golden corner, right? Same algorithm, up, down, doesn't matter, right? It's also here. You see it again right here, right? It's just over and over. Oh, pardon me. That one broke. But so there you go. There's an example of a slight break. That's a one tick break here before it goes up. But look what we do here to the tick. So again, we notice that you will see slight breaks. So likely, again, because there are people teaching this. I've been teaching this for 3 years. Others teaching it as well. The guy who discovered it, is a prominent educator as well, David Halsey, and you get a little history lesson of how we found his work and incorporated it into our work via the remainder of this video. It's very possible that there's a little bit of a widening here of the range here, but clearly they stayed with it, right? So here we go, golden zone comes down. It's possible here there's another little pull here that could be a target, but this is just, it's such a minor break on a wick. I think I'm right on that, right? That's literally a 1 tick break. So, and then here we're target to the tick. You see the reaction. But then you look at it, you start to combine all of this, and you can see how dominant this is. All right, so the structure here is just beautiful. So we come from this golden corner. Here's the median line. So here's your 80%, right, being realized, right? There's Andrew's trading principle number 1 right there. So that's the 80% getting tagged. We retrace. Now, again, right, you can just anticipate what you might see there. We retrace 50 to the tick. Here's that target, second target. Now here's third target. Right, and we do it again in an impulse. But note the precision of the geometry. That's to the tick, right? The outside edge to the tick. Now we come down here. Now this is kind of interesting here. Now we're catching it from reverse. This is often what you'll see as geometry is tested. So the outside edge here being tested before we head back up. We get, again, another golden here. This is where we had the slight, well, this has got to be pulled. Interesting, right? How you find it again. And then we get this version right here. Right, where we have the slight break, we go back 1, and there it is to the tick. Right, and then as we finish up here to the tick. All right, so they just kind of give you some ideas here of how we approach that. And then the remainder of this, as I said, will be an excerpt kind of going through the history of how we came to make this such a cornerstone of our TDU methodology. All right, so just a reminder, if you're interested in this or any of the things that we do, you can always join us for free. All right, you'll note underneath this video, you can join our Discord for free, and that will get you access to the white belt, right? Which is part of our entire belt system, which incorporates everything that I'm showing you here in much more detail. But then, if you're interested in working through the belt system, there's a whole lot of Elliott and then more advanced and sophisticated applications of this in the context of how we combine it all via Elliott, fib relationships, and geometry. Right, so always an option for you to join us for free. You can always join us in the social membership. If you're interested in getting into the trading rooms, that's just $49 a month. We think that's pretty reasonable. And then if you, from there, wanted to take a deeper dive into the more in-depth TA, that's through the belt system. All right, so all of that available to you. So with that said, I'm going to transition over here to the excerpt from that webinar. Of course, it's done in NinjaTrader, but because we're using this in the futures markets all day long, every day. Again, asset doesn't matter. It just happens to be a different platform where you'll see the same thing. All right, and then I'll wrap up in the last half. I'll just show you the last 10 days of the S&P in the futures market where you'll see, again, the same dominant algorithm. Okay, here you go. I'm going to do this in stick figures just to make it easy and just to get the language clear. I know this seems rudimentary, but just bear with me. I hope you'll agree with me that there's a payoff to this at the end of it. So if let me get my little pen tool here. So if we're sitting here just looking at a potential, nothing more than a potential pivot here, we've got a swing, we've got a range. Well, if it starts to come down, we have all of the ingredients here for an internal retracement. Now, naturally, we tend to think, well, if it's internal at this point, your expectation would be that the ingredients are there for this to continue on in the trend where you'd have a higher low, and then with the break here, you'd have a higher high. So you have just that potential there. Doesn't mean that we must carry on in that direction. It's just the ingredients of an internal retracement that has gone external. All right. So now we look at that and say, well, okay, of course, nothing says that it must go higher, right? We could go external here by breaking this low. So we still have an external retracement. But of course, that external retracement, unless you were at an all-time high, could certainly be part of a larger degree retracement where you get that same idea of an internal retracement that breaks the low and goes external, right? So just some language terminology. Now, in that same vein, we got to talk about the measured move. So the measured move in what would we call it? Classic TA. classical TA. I mean, it's still very, very much used today, and no doubt in my mind there are algorithms tied to it. But the traditional measured move is an A to B equals C to D, right? Simple conceptually, right? But of course, we have an internal retracement that goes external, right? Now, you see, the question then becomes, well, all right, well, if A to B equals C to D, well, what about B to C? How do we go about identifying the B to C? Well, that's where, of course, all your Fibonacci sequence would be the first place that most people would turn to in terms of potential support zones through that retracement. And while I've got the full suite of them there, the most common, of course, are the 38 through the 618, right? Again, I know this is very rudimentary to many of you. And this itself is often it's called the PRZ, a potential reversal zone. It's always just that, always just potential. And while the 38 is certainly significant, what we're going to do today is focus on the two most common, statistically, where you see the highest percentage of internal retracements pausing before going external, right? So we'll focus on the 50 and the 618. Now, so then the first question is, if you're a trader and you're looking at that, again, it would be a function of what time frame you're trading, that gap could be substantial in terms of dollars and cents. Well, is it the 50 or is it the 618, right? How do I know which one it's going to be? Or, do I sit here with a limit order at the 50 or a limit order at the 618? How do I pick which one is which? Well, of course, that's important, because if you're measuring for the A to B equals C to D, if we pivot at the 50 or of the 618, we're going to get a different target for D, right? Based on where that pivot is. Well, somewhere along the line, traders started to recognize that there was a pattern here that was mysterious. There was a gap that was showing up with a high degree of regularity that was a failure to make the 100. Now, it was showing up regardless of where we were on the pivot. We were still, again, each are going to give you a different location for the 100, right? If you come off of the 618 or the 50, you might have a different location. So it didn't matter. What was happening, we were coming up here, we were failing to make the 100. And if you weren't getting a complete trend change, you were getting a pause in the trend, right? So something was going on there. All right, so in terms of trying to identify this, well, we come back to the question, is it the 50 or is it the 618? How do we know? And if it is the 50 or the 618, how do we account for the fact that whether it's the 50 or the 618, that this location, the box up here, is always the same? Something's going on here. How do we go about identifying what that is? Well, there's a couple of different ways you might approach that, right? So just pulling out your trend continuation or trend extension tool from NinjaTrader, right? You would just grab your tool and A to B, you'd project from C to D looking for the 100, right? That's the obvious way. We've all done that a million times, still do it every day. So how do we project, right? So this, of course, the key is the location of C. Well, the way this was first taught to me was different than that. So the way I first learned it was that the location of C did not matter. Right? So you would still have your 38, your 50, and your 618 in here as potential pivots, but they were not determinant as to where the target was. So if you, again, using your trend extension tool, you just take the length of A to B and then you pull it all the way back down to A. And so obviously, right, this would be 100%. And the first target, again, as it was taught to me, would be the 272, right? You had a window here. Now, obviously, right, of course, we see moves go way beyond that, but this is first target. Now, if it keeps going, right, this is where, Elliotticians might jump in here and say, well, potentially you got a wave 3, that type of thing going on. That's sort of beyond what we're talking about here, but I just want you to focus on the first target, right? That was always, if you caught the turn here, once we broke this first target, the 1272, right? That's one approach to it. Now, Gan had a different approach. Gan, kind of looking at how the masters approach this. Well, of course, Gan, he's squaring price and time and then cutting everything in half and then cutting it in half again. So Gan would look at that same swing, and you would have, so we'd cut it in half at the 50, then cut that in half at the 25 and the 75, and then you'd square the whole thing up here. So then you would start that whole process going up. So Gan traders looked at that and said, okay, well, again, it doesn't matter whether it's the 25, 50, or the 75. Once I get a pivot here and I start heading higher, the first target is the 20. Well, it could either be the negative 25 or the 125. Wouldn't matter. It'd be the same location, right? So you get the idea. The emphasis being the location of C doesn't matter, right? All that matters is once we break this, that's our first target. Now, along comes David Halsey with his breakthrough book, right? I cannot give him any more credit here. If you have not read this book, I cannot recommend it any more highly. Now, Halsey is as far as I know, he's the first person to reveal the way computer algorithms, if you will, had taken this relationship and built algorithms around it, which is very much what we're going to focus on today. So his premise was that this was important whether we pivot at the 50 or the 618, but it was not functional to where our target was. Right? So he would propose that whether it was the 50 or the 618, this zone here was important because it would dictate how the algorithms responded, but the target always stayed the same. Right? Again, now whether or not we got a pause in the trend or a trend reversal, right, you didn't necessarily know, but something was happening here. So Halsey, I think, taking some inspiration from the way Gan did it, said, well, rather than the 25 and 75, what if I just took the fib numbers and I just ran them up? Right. So from here, from 0, we went negative 23, 38, 50, right? Just duplicating what was here. So this distance was exactly the same, right? So here. So once we break this, now we're going fib numbers again and again and again. And he distilled it down through his research that the two most common, where if we came out of the buy zone here, the two most common were the negative 23 and the negative 618, two fib numbers. Now, if we take those three approaches to try and identify a target for this external retracement, right? A target point here. If we do that and we combine all three of them and just lay them on top of one another, right? So here you can see the confluence that we get here. So we get this tight little box here between the 23, the 25, and the 27. So we have a confluence point here of three different technical approaches trying to identify that target. Note that they're all short of making the A to B equals C to D, all short of making the 100. Well, now you say to yourself, okay, well, wait a minute. Because certainly we see retracements go deeper than the 618, right? And still they can go up here and go to target. So you would still have a measured move here, right? We're just measuring the swing relationships. You still call this a measured move. So whether we go 786 here or even further, right? We still have an internal retracement. But as we head toward, if we hit the 100 here, well, look what happens to the relationship. Here I've got the 100 essentially on top of the 23. Now I've got a big gap. Now I've got the opposite here. I have the gap in the wrong order here. Right, so we're losing that tight confluence point that we have here when you stack these on top of each other. Now, additionally, right, and I credit Halsey on this, he revealed that what was happening is that the algorithms had been written so that if we came down and we broke the 618 here, that the algorithm would exit the market, because you had created enough distance now to where you had the potential for a new internal retracement, right? We got a swing high, we got a swing low, which is coming back up here. We've got the potential for that internal retracement to just end up here, right? So the algorithm would stop here. It would take the next internal retracement in the sell zone with that as its target. All right, stay with me. Now, important concept, again, revealed in Halsey's book. What he identified for us was that the way the algorithm was responding here, it would take an initial position at the 50 because the algorithm doesn't know whether it's going to pivot at the 50 and go to the target or whether it's going to be at the 618. So they would start selling, right? In this case, a sell. They would start selling at the 50, but they would continue. It's almost like they would ladder in, right? And we don't know what the volume is going to look like in there, but they would ladder in right up to the 618. Note, right, of course, the target doesn't change, whether it pivots at the 50 and goes here or whether it pivots at the 618 and goes here. The location doesn't matter. Pardon me. The location of the pivot doesn't matter to the location of the target. Right, now, so what that means is that, and you'll be astonished how often you'll see this, that two competing algorithms, right? And again, we're never going to know who's behind these, whether it's hundreds of institutions and banks, or we're just never going to know, right? But all we can do is identify this algorithm because it leaves this footprint. So you could certainly have a scenario here where one algorithm, right, could be competing, could be the same company, you don't know. One algorithm could buy it here at the 618, hit target at the same time the second algorithm or second company or just the next piece of code is selling it here at the 618. So this algorithm is reaching target right as this one is selling it. And you say, okay, well, all right, I can follow that. That seems easy enough. I get the basic gist of it. Slow down. Because you might think, okay, well, all right, that's easy enough to follow. Well, unfortunately for us as traders trying to decipher what this algorithm is going to do next, along the way, as we're coming down here, right, as we're coming down here, what do we have? Right, we've got another internal swing that has a potential reversal zone here with that same target. Let me take that out for a second. So following along with me here. Now, so you say, okay, all right, I got that. So I can see that this is important because I could just repeat here. So I could get the swing, come to that zone, go into target. Well, okay, fine. But no, the algorithm doesn't care that this happened, right? Doesn't care. All the algorithm sees is this pivot and this pivot. So there's multiple locations as to where this algorithm could kick in. So it could take this swing, and then as it's coming down here, we got another 50 and another 618 here. So it could come down here and then go off to a higher target. We don't know which one's gonna get it. Right now, there are methods that we've developed here to help us try and identify that. But at the end of the day, they don't know, but they don't care. And I'll explain that to you when we get more into it. Now, also an important point, note here that if you did get this, right, if we came, we hit the pivot and we go up here. Now, at this point, from this pivot, what that would mean is that you've now broken the sell side resistance because we've broken from swing high to swing low. We've now broken the last resistance of the algorithm. So you have no resistance up here. Right, a very important concept. Now, the only way you would get any sell side resistance from this carrying on is if it went here, didn't get to target, because remember, the target's going to be higher. If it came down here and went far enough and then started back up, now I got the whole problem, the whole challenge going again. I got another swing high to swing low where an algorithm, we'll get there. I guarantee you is going to be sitting there waiting to sell that to their 23.6. Right now, this is happening in every market with a decent amount of volume at every time frame across every asset class. I defy you to find one where you're not going to find it. You won't, because it's rampant. Now, carry on here before we get to the market. Now, my small contribution to this, emphasis small, was my observation that watching what was happening at the 618 is that often we would break the 618 and we'd go just a little bit further, but then we would still carry on and we'd hit target. So something else was happening here. Now you could just through deductive reasoning, you might think to yourself, all right, well, so new traders here that have just learned about the 618 are putting their stop because they've been told, well, put your stop just under the 618, right? You'll be okay. So likely that's part of what's happening there, that stops are being run, right? So the guy who doesn't know, right, or too tight on the stop, right, watches it go, off and break that pivot, right? Whether he's using this technique or not. But this was happening with a high degree of consistency. So all I did was just do a bunch of testing to see what was the most consistent, and that turned out to be the 65. So we call it, not very original, but we call this spread here between the 618 and the 65 the golden zone. So coming down here, this is your high probability location, because if we break here, then we know that the algorithm is going to switch, is going to take the next trade on the way back up. Now, so again, is our methodology here is combining different technical analysis methodologies here. This is a bit of a signature trade. So a pivot here in the golden zone going to that target with a set of median lines on top of it. We call it a golden corner pocket. Right? I can't, that name just popped into my head. I used to shoot a lot of pool when I was a kid, and I kept seeing an 8-ball in the corner pocket. Right, it's just what occurred to me. But this is, if you've studied any of Andrew's work, you know that this is his trading principles. He's got 4 dominant trading principles that if you draw the median lines here, the probability of making the median line is around 80%. That fact, that statement alone, right? If you're not aware of that, if that isn't on the tip of your tongue, right, that should be something you pay attention to. All right, just to put a cherry on top here, this is the 15-minute for the S&P futures here on the March contract here. I'm just going back to, we had this big sell-off here at the start, really the start of the year. We get a pivot down here, and then the whole process starts moving up. Now, right off the bat, you can kind of look at this and you say to yourself, oh, okay, well, perhaps I see one right there, or it's right here. Well, if we draw that up from the low, yeah, this is likely what happened here. This is likely a front run here off of the target. You will see front runs off of this. That's a couple of points here. This is pretty close. Very likely that's a front run. Now, if there's a couple of ways we could look at this. So if we zero in here, it's very possible that they used the secondary pivot here. So now we'd get wicking action here at the 50. Now we get there to the tick, and you say, well, oh, okay, well, what are you just randomly picking pivots here to find what works? Well, not so fast. The reason I'm using that pivot is because I know an algorithm used it. Right? So if I look here and I pull up here, I can see here we go right to golden zone. So I know it was used, and often that's what you'll find is that the algorithm will take a pivot that it used previously, and that again so I will often tell you, we don't know how because there's no way to know how many institutions, call them whales, call them banks, call them whatever you want, are using this. We just know that it's quite a few. But we don't need to know, because all we need to know is that it leaves a footprint, right? That's all we can do is track the footprint, right? So, and then it just keeps going, right? It goes, here, I got to take some of this off so you can see it, because it's up and down. All right, so here, come here, get that off of there. So then it keeps going, right? So what they'll do is they'll keep trading it until it fails. So here's 50 to the tick from this. So we have this pivot, this pivot, this pivot. Now we swing up, we get a rip up, down 50 to the tick. Little stutter here, right? Front run, possibly, right? We don't know. We're never going to know, right? So now you pull here, right? That's where we get boom, boom, right? Now how do we know it's an algorithm? Because of the reaction there, right? So it's 2%. Again, human beings, we're not that precise, right? So you see what comes off of that is all this volatility. So again, now here's one that doesn't make it to target, right? So if we come back here and we look at this here, right? So they're not always going to make it a target. What's interesting is look what just happens over here. But of course, this would have been this pivot is tied to a much lower pivot. So if we swing here, here's one we get into the buy zone. Now you can look at that and say, oh, okay, well we didn't make target, right? I mean, would you have made money if you're along that? Right, trailing stop, whatever it may be. But again, I'm just kind of demonstrating here. Now, then it kind of falls apart, because there are going to be times in the market where it's going to break on both sides. Right? You have to recognize that, and then eventually, because what the algorithm is going to do and the way they're written, they're going to just stay with it until they get on the right side of it. So there can be stops on the long, stops on the short, but they don't care, because eventually they will find the 3, 4, 5, 6, 7, 8 of them in a row, right? So the losers are all well compensated, right? They get stopped out. They don't care, right? Because so here we get. So clearly from the top, this would have broken. From the pivot here, this would have broken. So you've got, again, loser after loser here. If we were trying to trade that, right, that's why we like this, because the risk, right? So if you were, let's do it from the top. If you were in this from here, right, we come up to the golden zone, we get a 65 tag, and we get a little bit of a reaction. So your stop is so low here. Right, so low. So you want to be in this. That's the attraction here, is that I can be in this. If my entry is here and I pull back to just a couple of ticks beyond the 65, well, you get stopped out there, right? So do they. But again, they don't care. Same thing coming down. If you were looking here, let's just pull it from the other side. Right, so you certainly are going to have losers, right? It's not 100% on either side. So if you're on this side, all right, and you're pulling it up here. Right, we come down, here's a little reaction at the golden zone, you get a little pop off of it. Again, another small loser, right? You're going to have losers, right? That's just part of trading, right? But eventually you'll see it start to show up, and it'll find that pattern, which is why they continue to do it, right? So stop 1, stop 2, all of a sudden, oh, looks like it's starting to show up. So look what happens here. So from this pivot, we go here. There's the pivot there. We come 50, right to the 233. The Vegas wave is right there. First reaction is, if I'm to the tick on this, make sure I am, right? So there's second target to the tick. Again, we human beings, not that precise, right? That only software can do that. But do you note that inside of that, they've got a second one? Right? So if I pull from here, right, you see it again. Right, so here, so you see it twice, right? You got the big one, then you got the second one. There's this one here getting second target, but then you've got the inside one getting right here, right? Here's our sell zone between the 50 and the 618. That's where they start shorting. Gets through first target with a little buffer, and likely it's the larger algorithm drives it down here to get second target, and then the whole thing starts up. Right, now we look now, so again, just kind of a good example of combining methodologies and how we use this. Let's pull this off here. Now coming off of this low, what do I see here? Well, I don't get a retracement to a 50 or a golden zone, but what do I see? Right? I mean, it's hard to miss, right? 1, 2, 3. Looks like we got perhaps, or it looks like a running flat there, 4 going up for the 5, right? So there's your impulse coming off the low. So again, it's this combination of using these together. Now here, right, we apply a little Elliott, 2 through the 3. Here's the 23, golden zone. Up we go. Right, there you go. Just a few examples, and hopefully you got something out of that historical excerpt from that webinar. Okay, guys, there you go. Have a good weekend.